Okay, well, Alex, why don't we get started?
Right. Aloha, everyone. So this is Alex and Kurt with eMortgage Hawaii. We're doing our monthly educational webinar. Today, we're going to discuss the 2026 Hawaii Mortgage and Real Estate Forecast. Again, my name is Alex Provance. I'm the branch manager for eMortgage Hawaii. My contact details are on the slide here, but I'll also put them in the chat. Next, we have a list of our upcoming webinars. You can either sign up by emailing me or through the QR code that's on this slide. It'll bring you to a form that lets you select all of our upcoming webinars that you'd like to attend. And I'll also put that link in the chat. So this is going to be the 23rd year that Kurt has been doing this forecast. So we're grateful to share this year with you guys. And if you have any
Getting old.
questions, if you have any questions as we go along, either put it in the chat or on your microphone and just interrupt Kurt. And with that, I will hand it over to you, Kurt.
Okay, yeah, and I do prefer to be interrupted and you ask your questions verbally, but however you want to do it. So Alex mentioned that this is my 23rd year of doing this forecast. A little bit about me, I do have a master's degree in economics and a master's degree in finance, so there is a little bit of substance behind these forecasts, and this forecast is being brought to you with the help of MBS Highway and Barry Habib. Barry has been the #1 real estate and mortgage economist in the United States. Like four out of 10 years is his forecast. So Barry's a brilliant man. I work with him a lot, speak to him a lot, and this is in concert with Barry's work that he and his staff do and what we contribute, throughout the year. So, okay. So before we do a 2026, forecast, let's see how we did last year. So we forecast the 10-year Treasury because the 10-year Treasury will dictate where mortgage rates go. So last year we said we thought Treasuries could go as low as 3.8. And they went to 3.89. So that's almost a direct hit considering they were over 4.5% when we started the year. So I feel pretty good about, about that forecast. The 30-year fixed rate, we had a low target of 5.75 to 6%. And it got down to 6.1%. It's actually lower than that right now. So I think, again, that's almost a direct hit on a forecast, considering when we started this forecast, rates were in the mid 7% range. So I think we did really well there. Now, the mortgage spread, this is important when you're forecasting because mortgages follow the 10-year Treasury bill. And there's a margin. And that spread is important to understand because how the 10-year T-bill goes, plus where the spread is, will dictate where the 30-year fixed will end up being. That's how we forecast. So if you look at our forecast from last year, we thought the spread would drop from 2.8 to 2.25. It went down to 2.2. Again, I think that's a direct hit. I mean, that's pretty damn good of a forecast when you look at the spread. And a spread is very important as we look to set our forecast for 2026. Okay, home price appreciation. We had forecasted 3.5% growth and nationwide. And the actual was a little bit lower than that. So this was a bit of a miss, 2.6. Not horrible, but you can't be perfect on all things. And then the unemployment rate. While everybody else was forecasting lower unemployment, we are forecasting higher unemployment. And look at that. We again, almost a direct hit. So I think our forecast for 2025 was maybe an A-, B+. I think, you're kind of right there. And now you're going to see on how we build our forecast for 2026. And I think overall it'll be good for Hawaii real estate and good for Hawaii mortgage market. So I'm kind of giving you a foretelling of what we think. So to start our forecast, we have to look at inflation. Inflation is one of the things that the Federal Reserve is very focused on, and how the Federal Reserve's monetary policy goes, so will the 10-year Treasury and then mortgage-backed securities. So it's important to understand inflation. Okay, so this is where we are today. The personal consumption expenditure is at 2.8%, both the headline and the core. This is what the Federal Reserve looks at. But built into the PCE are lagging indicators that are skewing these numbers. So shelter, which is rent, people, what they pay to live in a place that they're renting, they're showing at 3.7% inflation. And it is 16 to 18% of what goes into the PCE. So it's an important factor when looking at PCE and what the feds look at. Now, the feds want this number, this 2.8, to be at 2.0. So we're about 0.8% higher. Then you look at CPI. CPI, we think, is a better indicator, but it's about the same as PCE. But look at how much of the shelter cost are in the consumer price index. 1/3, almost 1/2 of consumer price index is the shelter cost. And if the shelter costs are being overstated, then CPI is being overstated. And that's where we think we can look in the future and say, we think we know where inflation is going. And how do we do that? Well, one of the most important things is shelter costs. So shelter costs are a 12-month average. So we're looking back 12 months. And if you add up every month, it's averaged 3.7%. But if you look at the most recent data, new rents for people that are signing new leases, it's negative. It's not 3.7, it's minus 1.3. People that are renewing their lease, they're paying plus 3%. The reason for that is it's a pain in the butt to go find a new place, move, clean up the old place. So typically renewals get a higher rent than people that are signing new leases. That's just the psychology of it. But on average, shelter costs are at 1.9, not 3.7. That's a big difference. So this lag between a 12-month moving average and the current situation on shelter is a big deal. And it is showing that this is going to continue because we know shelter costs are continuing to decline. And part of that may be the removal of illegal aliens from the country. I don't know, but we do see a very stark decline in shelter costs. That will continue. So this lag will play out over the next 12 months and should have a big impact on inflation. Okay. So if you look at for some reason, it's not going forward. So our core inflation at 2.8. Now let's talk about tariffs. Most people think tariffs are inflationary. They are not. A tariff is a one-time kick in price. And it only happens 1 month or one period of time, and then it stays. And we've been about 8 months into our tariffs. So that rise in price due to tariffs, if there was one, is running out. And so right now we're overstating inflation by about 0.3% because of tariffs. And tariffs are not inflationary. It's a one-time price adjustment. Inflation is something that happens month after month after month. So it's important to understand that. The shelter lag is another 0.3%. And there's another thing I'm not going to get into right now, and that's portfolio management. And this is where people are being paid fees to manage your stock portfolio, your 401k, your IRA. And as the the stock market has risen so much over the last year, they're overstating the amount of fees that people have paid on their portfolio because they didn't sell their portfolio, or they're not rebuying other stocks. So they're not actually paying that much. So this is also overstated. So theoretically, we are actually at the Fed target, but because of all these lags in information and the way the Fed looks at things, they're a backwards looking organization. They're not a forward looking organization. They're seeing something differently. They want 2%. We think we're at 2.2, maybe lower. So we're going to be conservative. Over the next 12 months, we think there'll be a slow decline in inflation because of these lags. And for the next 12 months, on average, there's going to be about a 2.5% inflation rate. Now, if this comes true, this will relieve the Federal Reserve of their concern on inflation. Remember, we hit 9% inflation, and that was bad. Now we're getting down to something closer to their target. They're going to turn their focus to something else, and that's labor. So I don't think inflation is going to dictate the Federal Reserve monetary policy. I think the Federal Reserve monetary policy is going to be dictated by labor. So let's talk about labor, because we really need to understand where the Federal Reserve is going to go. So in 2026, let's take a look at job openings. Now, job openings is a good indication of what businesses are willing to do to hire. There's been a stark decline for the last 3 years, almost 50% decline in job openings. And this 7.1 million, there really aren't 7.1 million job openings out there. There are, a lot of these are duplicated, because if you have a job opening for somebody that could work from home, you might advertise that in 3 or 4 markets. So many of these job openings, because of the remote workforce that is now coming, into play, you might be 2 million overstated. So there may only be about 5 million job openings. And we're going to see where that goes, but it's clearly declining. So there's something going on in the job market that is not good, that the Federal Reserve is not recognizing, and they are not recognizing this. Now let's look at continuing claims. These are people that are on unemployment. It's obvious. We have more and more people on unemployment, and this doesn't really provide you with real numbers, because as people fall off unemployment and no longer get unemployment benefits, they're still unemployed. They're just not showing up in the numbers. Also, there are a lot of people, we call it the gig economy. And what I mean by gig, you get a gig, you go work and you get paid. You're a band member, you go on and play a gig and get paid. You're not on anybody's payroll. Uber is a good example of the gig economy, that you're going out and doing a job, getting paid, but you're not on their payroll. So a lot of people are out doing these gigs and not receiving unemployment, because they can make more money driving Uber than if they take unemployment. So there are a lot of people that are unemployed, not technically, but they're making money, but they're in that gig economy, but they're not fully employed. We all know that. So there's obviously weakness in labor market, and we believe that the Federal Reserve is going to start seeing this. ADP is one of the best reporting groups out there. They're a payroll service. They have direct information about private payrolls, and you can see it's very weak. We've actually gone negative 1, 2, 3, 4 months in the last 8 months have been negative job numbers. That means we've lost jobs. And I trust ADP way more than the government. If you look at the government figures, this is the Bureau of Labor Statistics. We call it the bullshit report. And I'm going to explain why. You can't even, it's worse than that even. But the BLS has overstated jobs, if you can believe this, since January of 2021. They have overstated every single month for 5 years of how many jobs are being created. But they are even showing 1, 2, 3 months of negative job growth. So obviously there's something going on. And if you dive deeper into the Bureau of Labor Statistics, and as you probably know, the head of the BLS was fired because of the inaccuracy of their forecast. If you just take one period, quarter two of 2024 to quarter two of 2025, they started with, there were 1.9 million jobs created during that period, during that 12-month period. They adjusted those numbers down to 1.5. Then comes I think it's the quarterly, I forget what the acronym, employment and wages, quarterly, I forget. Anyway, but this is the gold standard here. This is what really happened. They calculated there were only 420,000 jobs created in that 12 months. So the BLS overreported job creation by 73 to 78%. So 3 out of 4 jobs that they reported were created never existed. And that's how bad the government reporting is. And is it political? I don't know. I mean, I don't know why, but you certainly can't depend on it. And it really comes down to the adjustment that they make with the birth and death model for new companies being formed and current companies going or closing. And they said that there was they attributed 1.119 million jobs to new businesses being formed, and that just never happened. So their model is broken. And we know, because unemployment is going up. I mean, you can't have these two things happening at the same time. So we know that unemployment is going up, and that's a sign of weakness in the economy. So our guess is that the Federal Reserve is going to turn their attention to unemployment and forget about inflation. I think inflation is going to run its course, and I think the unemployment, the labor market, is going to become more important. So we're forecasting a continued rise in unemployment. Why is this important? It's because it will change the monetary policy of the Federal Reserve, and that will change mortgage rates in the end. It takes a long time for these things to play out, but we're going to talk about a few things that have already played out. Okay, so let's get into the forecast about the Fed. I've kind of leaned into this already. What is the Fed going to do? It's important. Now, remember that the Federal Reserve lending rate, when they cut their interest rate, the last 4 times they cut their interest rate, what happened to mortgage rates? They went up. The reason for that is the Federal Reserve overnight lending rate really has nothing to do with mortgages, but their monetary policy does. The monetary policy is, are they growing the money supply? Are they shrinking the money supply? They've been shrinking it, and that makes money more expensive and raises interest rate. So why would they be reducing the overnight lending rate while they're shrinking the money supply? And that's a big question. Why would they be doing that? And that's the frustration I think the Trump administration has with the Federal Reserve right now, is they've got one foot on the gas pedal and one foot on the brake. So we're going to look at the Federal Reserve, the composition of the voting members. If you look, we don't know who the new Fed chair, I think it's going to be Kevin Walsh. He's a dove. Trump is not going to hire anybody that isn't a dove. And a dove is somebody that wants to loosen up the monetary policy, reduce interest rates. So doves are looking for interest rate deductions. Centrists are, they're on the fence. And then there's the hawks. And some of these people, I don't know what they're looking at. Like this Beth Hammock probably doesn't have any idea what's going on in the labor market. So there's only three hawks. So the Federal Reserve is going to be much more, I think, dovish when it comes to monetary policy, which means not only will they probably reduce interest rates, the overnight lending rate, but they're probably going to also loosen up on the money supply and the monetary policy. So we believe that the Federal Reserve is going to have 3 rate cuts this year. We're probably the only ones saying that, but you got to stick your neck out sometimes. So we see 3 rate cuts. The Federal Reserve rate will drop from 3.625 to 2.875, and that should have a direct reflection in the 10-year Treasury, and then that will then influence the mortgage-backed securities market and mortgage rates. So we do see continued funds rate reduction and a continued reduction in mortgage rates. So let's look at our forecast for mortgage rates. So we get to mortgage rates after we think about all these other things. So why do we think mortgage rates are going to go up or down? Well, through the components that affect it. Inflation, we think inflation is coming down. Monetary policy, we think it's going to become more dovish. The 10-year Treasury, we think, is going to decline. Okay, so let's look at the 10-year. Scott Besant has, this is Barry Habib, by the way. He owns mortgage-backed MBS Highway. He's met with Besant several times. He's also on the board of directors of Fannie Mae, which is an interesting thing that's going on there right now. But Besant wants to move the 10-year Treasury to below 3.9. We think it might go a little bit lower than that. The factors that are going to influence mortgage rates, the country is still taking on debt. That's not good. So the more debt we have, the higher the interest rates, just the way it is. But to battle that, Scott Besant is looking at buying or selling long-term treasuries and buying short-term treasuries. So he's looking at moving to more short-term interest rates to reduce our cost of capital. And that's good. Bank deregulation. This is a big one. This is where banks can be kind of turned loose to buy more mortgage-backed securities and treasuries. We think that will be good for the market. So bank deregulation could actually really influence where mortgage rates go. The Genius Act, I don't know if you know much about stablecoin, but stablecoin is, this, where the government is kind of turning to these Bitcoins and on the international financial markets. But the stablecoin has to purchase treasuries and mortgage-backed securities in order to make sure that their coin is ultimately stable with the US dollar. So that will help. And then if the Federal Reserve really does get into quantitative easing, then we believe that, and I think this is going to happen. And now let's talk about quantitative easing. And I see we do have some questions. I'll get back to you here in a minute. But on the quantitative easing, it already happened. So the Federal Reserve has already said it's going to start buying about $20 billion a month of mortgage-backed securities, and that happened a few weeks ago. On top of that, Trump came back in and said, hey, we are going to require Fannie Mae and Freddie Mac to buy $200 billion of mortgage-backed securities. So that's a big demand for mortgage-backed securities. The higher the demand, the higher the price, the lower the rate. So you want mortgage-backed security prices to go up, and that will force interest rates to go down. And in fact, that's already happened. So we've seen about a quarter point reduction in rates in the last 10 days due to this quantitative easing that the Federal Reserve actually wasn't part of. It was the Trump administration pushing for Fannie Mae and Freddie Mac to start buying back their own mortgage-backed securities, which is really interesting. So I see Ken's got a question about the tariffs. So again, if you look at tariffs, and it gets a lot more complicated than something that we're going to cover right here. But firstly, you got to look at, let's say, so Ken brings up that Trump is pushing more tariffs onto Europe. So then you got to look at, okay, what percentage of our goods and services are being brought in from Europe? They're being brought in a wholesale environment. So let's say, for example, if Home Depot bought a shovel from China, I'm just using an example. So Home Depot buys that shovel from China for $8. Well, when it gets to the shelf, that shovel might be $35. So you're paying a tariff on what the import price is. So it's a much reduced price. It's in the chain, in the supply chain. So a tariff on import goods is not related directly to the retail price. So it's muted in a way. That's why all of these tariffs really haven't had a big impact on inflation. And in fact, we see it as 0.3%. So in 2025, we believe that all of the tariffs that we slapped on countries around the world had an effect of about 0.3%. And that's you can do different analyses to get there. And then the question is, well, who actually pays for that tariff on that $8 shovel? Well, maybe China does, the producer in China pays a little bit, maybe Lowe's pays a little bit, or Home Depot pays a little bit, and maybe the consumer pays a little bit. So you keep breaking it up, and not all of it is going to be reflected into the price. And the proof is in the pudding. We've seen this. We've had almost a year of tariffs, and inflation has been going down. And again, most of the tariff activity is behind us. It's in our rearview mirror. Now, there might be some, jogging along with, Europe or somebody else because there's something else going on that they want them to do. But tariffs are a big sledgehammer when it comes to politics, and it can be used to sway countries to do things that the United States feels is in their best interest. So that's the way it's being used. Okay. So
there's a follow-up question, Kurt.
Oh, I'm sorry. Got a bill a month later for $40. These tariffs. I'm not sure of the question. They got a bill a month later for $40. I'm just, so Ken is asking, you buy $200 worth of clothes from China, how much of that bill is going to be tariffed? And it's the wholesale amount. It's what hits the port, and that's just the way it is. I'm not sure if that answers your question, but it's
curious about Sorry, Kurt. I think he's curious about the difference between wholesale and personal purchases, and seeing tariffs on both, whereas we suggested that it was just wholesale.
Yeah, I mean, tariffs are only on the value of the good hitting the port. That is not what you pay in the store. So there's supply chain between the port and the store, and then the question is, who's actually going to pay the tariff? And it's really be broken up between everybody in the supply chain. It's the producer, it's the shipper, it's the Lowe's and Home Depot, and it's the consumer. So by the time it gets to the consumer, it's not a major issue, and you can prove it just by looking at what the inflation amount of all tariffs in 2025 amounted to 0.3%. And that's going to run off because generally it's a one-time thing the tariffs were the tariffs, and they're not adding more and more and more and more every month. So it's not inflationary. But okay, I got to move on. Okay, so let's look at the 10-year Treasury. Where do we think the 10-year Treasury is going to go? Because mortgage rates are going to follow the 10-year Treasury. And you can see it's pretty volatile. But we believe, because of the things that we just talked about the Federal Reserve, Steve Bessent, what he wants to see, we think the 10-year Treasury is going to end up somewhere between 3.6 and 3.8%. We bounce around right there at 4%, almost every week. But that's where we think it's going to land, is somewhere between 3.6 and 3.8. So let's look at the high side. So when you look at a 30-year fixed mortgage, the rate spread is important. Now, normally, if you look, the rate spread is usually, mortgage rates are 1.6 to 2% higher than the 10-year Treasury. So if the 10-year Treasury gets at 3.8, we should see rates of 5.6 to 5.8. I mean, that's where it should be. We're currently at a spread of 2.12, and it's coming down, and it's going to continue to come down, because it's almost a kind of self-fulfilling prophecy. As mortgage rates go down, the spread shrinks. And the reason for that is because servicers make more money on lower rate mortgages. They're willing to pay more for them. So it reduces the interest rate. So that spread is going to come down, and we believe it's going to land somewhere below 2%. And once if you add that to our forecast for the U.S. Treasury, then you can do our mortgage forecast. So we think the 10-year Treasury 3.8 probably is high. The spread narrows to 1.9. We think we'll stay around 5.7 throughout the year. Now, this was forecasted before the Trump administration put the tariffs on. I mean, I'm now thinking tariffs. Asked Fannie Mae and Freddie Mac to buy those $200 billion of mortgage-backed securities. So guess where we are today? So the 30-year fixed is at 5.875%. The 7-year ARM, I'm an ARM person. Nobody holds on to a mortgage for 30 years, and you're paying a premium for that. Most people only hold the mortgage for 5 to 7 years. So I think, depending on your situation, you should be looking more at the 5-year, the 7-year or the 5-year ARM, and those are in the low fives. I mean, that's a big difference from where we were 30 days ago. And if you look at the government loans like VA, USDA, FHA, they're all below 5.5%. Now, the market hasn't realized all of this yet, in my opinion. So I think there's going to be a big jump in demand for real estate because of the pent-up demand that we've had for housing. So that's where we see mortgage rates. I think you could actually be around 5.5% for most of 2026. And if you look at everybody else, pretty much forecasting above us. Now, the only reason Fannie Mae came down, they were at 6.1%, is Barry Habib is now on the board of directors of Fannie Mae and convinced them that, they're looking at things from a kind of a clouded window, and they lowered their forecast to 5.9%. So again, we think we're going to be below probably 5.7 to 5.5. It could be very realistic. And I think that's really where people really start moving on property. And if you can get an ARM, if rates go to 5.5, you're going to see ARMs in the high fours. So that's going to be pretty amazing if that happens. And if you look at what that does to people, if interest rates get to 5.5%, there's 9.7 million households that could reduce their rate by 0.75%. and save a lot of money. So you're going to see, I think, kind of a dam bursting if we do get into this 5.75 to 5.5% of people buying and refinancing. So let's talk about real estate now. Let's talk if you're on the looking at a forecast of real estate, you got to look at a couple of things. That's supply and demand. But before we do that, let's look at where Hawaii ended in 2025. So Honolulu, obviously the biggest market, it's the most consistent when looking at how home prices are moving. It's a better indicator. It's just a bigger market. It's right where, you know, we thought it was going to be 3.5%. Is it right on our forecast from last year? Condos dropped. This is kind of expected. People that were doing short-term vacation rental and, you know, if they were pushed out of short-term vacation rentals, they sold. Also, condos had a big problem with insurance and HOA dues. So the condo market has really struggled in Hawaii. On the Big Island, we are only up 0.92%. If you tear these numbers apart, the only reason the Big Island didn't grow more is because a majority of the home purchases shifted to the eastern side of the county. So Puna, South Hilo, North Hilo, that is a majority of the sales. And a lot of that had to do with people from Maui, couldn't find homes. They moved to Big Island looking for inexpensive places to live. So it really pushed. It's not, you know, the median home price, remember the median home price doesn't directly show whether prices are inflating or deflating. It just means the middle sale was 550. So that has a lot to do with it. If there's a shift towards less expensive homes, and you would expect that in what was a rising interest rate market. So you would expect people to shift towards less expensive homes. And then with the crisis in Maui, people moving to Big Island, there was just a shift in demand away from second home, $1 million homes to people needing a home on the east side of the island. And then condos were also down, just like Honolulu. Hawaii was an anomaly. I don't know what drove this, up 11%, but there's not enough sales sometimes in Kauai to really get a good statistical average. So it just may be a different mix of buyers. You know, it's hard to tell. And then the condos again. Condos are suffering. You know, there's no question. I think the insurance problem will go away. I think that there'll be new competition as soon as the people get the bad taste out of their mouth. And you'll probably see insurance costs come down, HOA dues come down. You'll probably see these condos inflate back up a little bit. And then on Maui, you know, if you look at the median home price, it dropped 2%. That's kind of expected because there's a lot of the people that lost homes in Maui and Lahaina, you know, they were, you know, the workers, they were full-time there. They're not living in the McMansions. And so they had to gravitate towards the less expensive properties. But look at condos, my gosh. Again, I don't think this is a big deflation in value of condos, more than a lot of people looking for a new home because they just had their home burned down and they had to find the cheapest thing they could get. And I really think looking at Maui, you can't, you can't, you know, look at these numbers and say, oh my gosh, it's crisis. And I see these people on YouTube that do that, but it's a demographic shift. There's a bunch of people who are the working class that had to relocate and buy new places. And so that big, you know, kind of bubble of people is distorting these numbers. It will probably take a couple of years for this to work its way out. But my guess is this is not really as deflationary as it might look. So anyway, that's kind of the way to look at it. I think the rest of the islands are Oops, I jumped ahead. I think the rest of the islands kind of show consistent numbers, okay,
And
so
then
that's
Kurt,
the. Mhm.
looks like we're gonna have Mike unmute. He has a question for you.
Oh, okay. Yeah, go ahead, Mike.
Yeah, Kurt, you more or less touched on this, but I just had a quick question about the relationship between the rental market and or just rents in general, and then what the impact's going to be specifically on the west side of the island. I mean,
Mhm.
in my past life, typically when the rental rate exceeded what a mortgage would be, people flooded into purchasing, and then the inverse happened when it counterbalanced. What do you see if there is downward pressure on rents for either nationwide due to demand going down or fewer people living in the country or whatever the case is? How do you see that impacting what not necessarily mortgage rates but housing values will do down the road?
Yeah, again, rental rates are not the primary mover of home prices. And in fact, I think Trump is trying to eliminate these institutional investors gobbling up all the real estate. So, and I think that's something's going to happen there, I think, because they are driving real estate prices high.
Yeah.
But I think you're 100% right that rental costs have gotten to the point that if you're looking at long-term rentals, long-term rentals have gotten to the point where people are either going to move to the mainland or they're going to need some relief. And so I don't see real estate rents going up more than 1 or 2, 3% per year. I think it's going to be very muted. I don't see this continuing, and especially if the Trump administration can, I don't know if legally they can do this, but if they can pull institutional investors out of the real estate market, which I feel it would be very helpful. But the real issue, and we're going to get into this in the supply side of things, is we're not building enough homes, and we are woefully underbuilding in Hawaii. We're the worst state in the United States of building new homes for new household creations. And so I think there's going to be a big move in new home construction. And I also think there's going to be a big move in using new technologies to build homes that are better built, cheaper to build, and use less on-site labor. And even my wife and I are looking at this on a home that we want to build. Is we're going to try to eliminate as much on-site labor as possible, and there are ways to do that, and that dramatically can reduce the cost of a home. So I think there's going to be a lot going on over the next 10 years, but we're 4 or 5 million homes behind in supplying housing for our population. So now we have homes where you got kids that are 35 years old living with mom and dad still. They would never have done that before. And so, the construction industry has simply got to pick up. And Trump is making it, I don't know if you've heard the latest, but they're talking about build baby build instead of drill baby drill. So they're going to do some things to incent companies to build more homes. And I think these companies are now looking at technologies that will make home construction less expensive. So, again, if you look at, I don't think there's any way we're going to have real estate prices going down in any time in the near future, and I'm going to show you why. But we're going to have to balance supply and demand, and that's just the way it is, and we're not doing that. So hopefully that answered some of it. So
Yeah,
this is exactly kind of good lead in, Michael, is if you look at household formations, this is the demand side of the curve on real estate prices. And normally we generate about 1.8 million households a year. And we were doing that up until 2020, late 2024. And look what happened. There was a crash in household formations. I mean, we've never seen anything like this that quick. And what happened here? Interest rates went up pretty dramatically. and people that were supposed to leave home and go start a family didn't. So 2025 was a stagnation of younger people leaving home and starting their own household. So we know these people are still there. We know that they still exist, but this is a definite pent-up demand that is going to come loose. And so once interest rates get low enough, they're going to re-enter the market. And I think we're almost there right now. I think we're there. So I think once they learn that they can get a 5.25% 7-year ARM or a 5-year ARM, I think this is going to come loose. And I also think parents are going to start pulling some equity out of their homes and helping their children get the hell out of their house by helping with their down payment. But I think this is a big deal. And if you look at supply has kind of followed along. Builders are not stupid. They're looking at household creations and they're reducing supply. But again, we're still 4 or 5 million homes behind. It would take us years to catch up. And we're just not doing it. So something has got to happen, I think, with the Trump administration to inspire builders to build more, and for these Gen Zs and Gen Xs to start leaving home and starting their own families and creating a household. But it's heading our way. So I think the housing market is going to be strong. I think real estate is going to stay, a great investment. And you can kind of see what's happening. If you look at interest rates dropping over the last 6 to 7 months, what happened to pending home sales? They started rising. So there is a real strong relationship. We call this the elasticity of demand, that the lower the cost of the house, the higher the demand. And you can see this is a perfect relationship. So we think this is going to continue. So we think that real estate values will hold. We think a lot of people are going to re-enter the market that were sitting on the sidelines. And so we really feel that real estate, now if you look at everybody else's forecast, pretty meager, 1.3 to 4%. We're kind of in that 3.5% range again. But we certainly don't see any collapse in values because there's just too much demand and not enough building. We're just so woefully behind in construction. So just to recap all of our forecasts, unemployment rate will probably rise a little bit more. The one thing we don't know about and we didn't talk about is all of this money that was promised from these foreign governments and corporations who are going to build car factories in the United States. I mean, something like $9 trillion. When is that going to hit? When that hits, you're going to see this unemployment rate go down. So, we'll see. Core inflation, we think it's going to go down, probably average 2.5% for the year. Again, we can get in. I could do a whole session on tariffs, but we don't think there's going to be. I think the tariff issue is, for the most part, in our rearview mirror and will trickle off. It has to trickle off. It takes 12 months to trickle off. Fed funds rate, we think, will decline. Mortgage rates, 5.7, 5.5, somewhere in that range. We're almost there right now. And home price appreciation, 3.5%. So I think, it's a forecast that is, I think, pretty bullish on the real estate market and the mortgage market. It's certainly not a forecast of anything dire happening. And there could be something happen in the world political environment that causes something. But if everything kind of goes the way it is, especially with this money coming in on this unemployment rate issue, if we get a bunch of money hitting our economy and construction, we could see unemployment come down a lot more than what we're showing here. And that would be a good thing. People earning money, they buy homes. So that'd be good. Okay. I'm going to open it up for any other questions, and just unmute if you've got any question or. But again, I think the market is going to be better than 2025 for both real estate and the mortgage industry. So I think we're on our way right now. So last 10 days have been pretty amazing in terms of rate reduction. So with that 200 billion coming out of Fannie Mae and Freddie Mac. So, and remember, we have these other webinars. The next one is an important one, is how to get the best mortgage rate. A lot of people don't learn about this. There's a lot of things that you can do and we can do together to get you the best rate. So I want to go over the things that get factored into your mortgage rate. Why does one person get 7% and another person gets 6%? That's a big deal. So we're going to talk about that. And then we're going to get into VA loans in March. Lava Zone 2, we just have too many calls. We're going to do a seminar on Lava Zone 2. That doesn't affect very many people. And then in May, we're doing another non-qualified mortgage seminar. These are low documentation loans, no income documentation loans. So anyway, those are the upcoming seminars. And you've got Alex's email?
Yep.
Yeah.
And if anybody would like a copy of the slides, if you want to just throw your email in the chat, I can get you a copy of the slides. And we will also have this recording up on our YouTube channel, as well as the previous 5 that we already have done.
Yeah. Okay, everybody. Well, enjoy your rest of your weekend, and go Broncos. All right.
Happy New Year.
Hey, Kurt,
Yeah.
real quick. I just had a question for how, when that foreign investment eventually does kick in, how do we see that on the ground? Is that easing up on building requirements? Is that taxes decreasing? We're all waiting for that money to come in, but how does that actually impact the market down the road for regular folks?
Right. And I think that I think that there's a couple of really important factors. You mentioned one of them is deregulation. With those investments, Trump promised less regulation, faster permits. That'll help everybody. That'll help the mining industry, the oil and gas industry. It'll help everybody. So that could lower cost. That could help with inflation itself. On the flip side, there's going to be demand for labor. Some of it's going to be temporary construction labor, but you got to have somebody go build all this stuff. And so you should see a drop in unemployment as that hits, and those might be really good paying jobs. So we could see unemployment rate drop quite a bit, especially in the trades. I think that's a good thing. And then at the same time, Trump wants to push housing starts, and that's going to push trades. And so I think if you're in the trades, if you're an electrician or a plumber or a welder or something like that, your future looks pretty good. But for the whole economy, that pushes up taxable incomes, that increases our IRS revenues, that helps to lower our deficit, and maybe we'll get to a no deficit. I don't know. We're going the right direction right now. That's for sure. So we trimmed the deficit by a lot in the last 12 months. So we'll see. It's so hard to predict how much of that's going to actually happen and when it's going to happen. But it's going to be good for the U.S. economy. There is no question about that. And if we could get our deficit to zero, that is a big step for this country, is to get to a point where we're generating enough income to pay our bills. And we haven't done that since the Clinton administration. So, yeah. Okay.
Thank you.
All right. Thanks, everybody.